Hi everyone, I am Dr. John Sigloria, Assistant Professor, Department of Business Administration CA in St.Joseph's College of Arts and Science, Autonomous, Cuddalore. Today we are going to discuss about accounting concepts and conventions in the subject of accounting for managers in Unit 1. First thing, accounting concepts. If there are 9 number of concepts in this accounting, number 1 business entity concept, number 2 money measurement concept, number 3 cost concept, number 4 going concern concept, number 5 dual aspect concept, number 6 realization concept, number 7 accrual concept, number 8 accounting period concept, number 9 revenue match concept. So first thing, business entity concept. Entity concept states that business enterprise is a separate identity apart from its owner. Accountant should treat a business as distinct from its owner. Business transactions are recorded in the business books of accounts and owner transactions in his personal books of accounts. That is called business entity concept. Number 2, money measurement concept. Money measurement concept hold that accounting is a measurement and communication process of the activities of the firm that are measurable in monetary terms. Thus only such transactions and events which can be interpreted in terms of money are recorded. For example, a non-monetary event like death, dispute, sentiments, efficiency, etc. Are not recorded in the books. That is called money measurement concept. Number 3, cost concept. According to cost concept, the various assets acquired by a concern or firm should be recorded on the basis of the actual amount involved or spent. This amount or cost will be the basis for all subsequent accounting for the assets. That is called cost concept. Number 4, going concern concept. The financial statements are normally prepared on the assumption that an enterprise is a going concern and will continue in operation for the foreseeable future. Hence, it is assumed that the enterprise has neither the intention nor the need to liquidate or curtail materially the scale of its operations. The valuation of assets of a firm, the valuation of assets of a business entity is dependent on this assumption. That is called going concern concept. Number 5, dual aspect concept. This concept is based on double entry bookkeeping, which means that accounting system is set up in such a way that a record is made of the two aspects of each transactions that affect the records. The recognition of the two aspects to every transactions is known as dual aspect concept. Number 5, realization concept. According to this concept, revenue is recognized only when a sale is made, unless money has been realized, cash has been received, or a legal obligation to pay has been assumed by the customer. It prevents business firms from inflating their profit by recording incomes that are likely to occur, that is expected income or gain are not recorded. That is realization concept. Number 7, accrual concept. Under this accrual concept, the effect of transactions and other events are recognized on mercantile basis when they are occur and they are recorded in the amounting record set and reported in the financial statements of the periods to which they are related. That is called accrual concept. Number 8, accounting period concept. It is customary that the life of the business is divided into appropriate parts or segments for analyzing the results shown by the business. Each part or segment so divided is known as an accounting period concept. The results of operations and changes in the resources which have occurred since the previous statements have been prepared. Normally, the accounting period consists of 12 months. That is called accounting period concept. And number 9, revenue match concept. In this concept, all expenses matched with the revenue of that period should only be taken into consideration. In the financial statements of the organization, if any revenue is recognized, then expenses related to earn that revenue should also be recognized. And this concept is based on accrual concept, as it consider the occurrence of expenses and income and do not concentrate on actual inflow or outflow of cash. That is called revenue matching concept. Next heading, accounting conventions. The accounting has to follow the conservatism principle of playing safe while preparing the financial statements, considering all possible loss scenarios while recording transactions. If there are 3 types of accounting conventions, number 1, conservatism, number 2, consistency, number 3, full disclosure. First one, conservatism. The lower value is generally considered since these conventions consider the worst case scenario. In sometimes it is observed that private reserve are being created by showing excess provision for bad debts and doubtful debts, depreciation, etc. are the examples of conservatism principle. Next one, consistency. Once a particular method is selected by the business, while reporting, it should be followed consistently in the ensuing years. This principle is help for investors and analysts to read, understand and compare the financial statements. If the company wants to change the method, it should do so only with good reasons to make specific changes. Certain points criticize this principle, like considering certain items on a cost basis while others at a market value, while the principle of consistency in accounting. That is called consistency. And third one, full disclosure. Relevant and important informations regarding the company's financial status must be revealed in the financial statements even after applying the accounting conventions. For example, contingent liabilities and lawsuits against a business should be reported in adjoined notes in the company's financial statements. This topic is definitely useful for all of you. Thank you so much.